And we're live.
We're live. Well, Tony, thank you for joining us in our podcast. And we know you well. Mike knows you well. But for our viewers, can you briefly please give us some of your qualifications?
Sure. Thank you so much for having me. Very excited to be here. My name's Tony Watson. I work for Robert Hall & Associates. I am a full-time tax consultant, tax planner, tax strategist. My license designation is as an enrolled agent. I hold a federal license to prepare taxes in all 50 states. I can represent clients in front of the Internal Revenue Service, State Franchise Tax Board, or any state franchise tax board across the U.S., Board of Equalization, Employment Development Department, basically anything in the income tax world I can assist with. I work for a firm that is over 50 years old. We service around 12,000 tax filings on an annual basis. We are all enrolled agents. We have about 56 employees at Robert Hall & Associates, and we are very much a go-to tax preparation firm in the Southern California area, but we do actually have clients in all 50 states, which is something that's very unique about our firm. So
Fantastic. So let's get into, as they say, the meat and potatoes, okay?
Mm-hmm.
You know, when I spoke to some of my colleagues that we were going to have you for the podcast, Proposition 19 kept coming up again and again and again. Some of my colleagues are very concerned about that. Can you touch on that a little bit, please?
Sure. So the propositions, which deal mostly on the local side, from a tax perspective, my license is on the federal level, so I prepare federal income tax returns, state income tax returns. When we deal with the local county tax rules and legislations and the propositions, I always have to mention that as much as I know about the propositions, I am not a professional in this area of the tax world. So I suggest for people to reach out to us on a personal level,
Okay.
and we can go into more detail about their specific scenario, because everyone's scenario is unique and different. As far as the propositions are concerned, this has been a growing concern for a number of our clients here in Southern California, especially because of the value of California real estate. The last thing that someone wants to do when they lose a loved one is have to pay an increased property tax payment on the value of the property as of the date of passing.
Right.
So some of these propositions in the state of California are requiring people to do a little bit more planning ahead of the loss of a loved one, the loss of a parent or a grandparent. And these propositions are very confusing for a lot of reasons. But the main focus for a lot of people is that when I inherit a property from a parent, and let's say that they bought this property 40, 50 years ago, it's no surprise that if you bought a California piece of real estate 40, 50 years ago for $200,000, then now this property in certain parts of California could be worth $2, $3, $4+ million, right? And obviously on the income tax side, there's a whole stepped up basis benefit, which allows people to inherit a certain amount of capital assets tax-free based on this whole stepped up valuation upon death. And people tend to get this part of the tax world confused with the property tax reassessment
Correct.
side. They're two completely different worlds.
And I would say, sorry to interrupt you, many Californians don't know about it.
They don't.
They don't.
They don't, which is very sad, because that means, one, either they have not consulted with a tax professional in past years, or two, they are consulting with a tax professional that isn't focused on strategizing and planning for the future for their client.
Correct me if I'm wrong, just to keep it simple for people. The capital gains step up in basis means if you sell the property after inheriting it, you're going to have a benefit because of the step up in basis.
Correct.
The Prop 19, what my dad's referring to, has to do with the property taxes. So you're
Correct.
keeping the property. You're not selling it. You're trying to keep it. The property taxes have gone up.
Correct.
So those are the two different scenarios.
Correct. And here in the state of California, under these new changes and these new propositions, if the inheriting party, if the child or the person who is of direct familial relationship to the deceased, if they want to keep the same property tax base, they have to physically move into that home.
Correct.
And establish it as a primary residence. Most of our clients that we've seen who are inheriting property from family members, they want to keep the property and they want to rent it out. The problem is, and from a rental perspective, yes, the stepped up basis happens on the income tax side, which increases depreciation write-offs, and there's a whole other world of benefits that we can map out for our clients. But on the property tax side, even after all of those income tax benefits kick in, as you can imagine, a property tax payment on a $200,000 property 40 years ago, if they don't establish it as a primary residence, if they don't choose to move in, and now they get reassessed on the property tax side, well, what is it, 1.5% of the new value of the property, which let's just use an example at $4 million. Most inheriting parties don't want to pay 1.5% of $4 million in property taxes. And there are some adjustments. I'm being very vague with my calculations here, but in order to keep the property tax base low, 98% of the scenarios would be the inheriting party moving into that home and establishing it now as a primary residence. And like I mentioned earlier, every scenario is unique. Every scenario is different. So I'd suggest people to reach out to Robert Hall and Associates, and we can map
So the reason I brought it up is, like I said, many people ask me to ask you this question. This is fairly new. This apparently was voted in on February 16th of 2021.
Yes.
Okay? There's very few people that know about this. So they think that by putting the property in a trust, they're going to have that step up in basis, but they don't realize that unless they move into the property, okay, the property will be reassessed. And you could technically get a bill, for $18,000, $19,000, $20,000 that you're not expecting. Mm-hmm. So contact your professional that you're dealing with, okay? And make sure that you have some tax preparation for something like this, because it's catching a lot of people off guard. I was surprised to read an article that said that 72% of Californians are not aware that this happened.
Yeah. I would think it was a larger percentage. Actually, than 72%.
Yeah, 72 to 82. But so there's a great point. So if anything, this is one great point to provide to our viewers. Double check everything. And moving into the property as a primary resident is not as easy as it sounds to many people.
Right.
They have families, their kids are in schools. So to change your primary residence to another location can be tremendous. So what's the outcome is, unfortunately, you have to sell it.
Mm-hmm. And that was the main push on the state of California side, is that they did not want people continuing to own properties for investment purposes while keeping that property tax base low. And so they are essentially playing a poker hand. In this case, they are forcing the hand of the inheriting party to force the sale of the property. But once again, I do want to make sure that I remind everybody that the property tax world and the income tax world, two completely separate worlds on the tax side, or the tax side of the conversation. A lot of people focus on the proposition side without knowing the major income tax benefits of inheriting a capital asset that has grown so much in value. Mm-hmm. And so you want to make sure that your tax advisors are mapping out the capital gain situation, the tax-free windfall benefit of inheriting an asset up to what the estate exemption is set to change, I believe, in the upcoming years. But currently it's $12.6 million per individual. So that's $25.2 million for a married couple, $12.6 million for a single individual. That means that when my parents or loved ones pass away, I can inherit up to, if I was single, I'm married, so married filing joint, $25.2 million of tax-free capital assets. That includes stock inheritance with a stepped-up basis. Most of the time it deals with real estate, because once again, if a parent bought a property for $200,000, now it's worth $4 million. People think, well, if I sell it, I'm going to pay the tax on all of this. Well, no, technically, if you waited until after a parent passed away and you are the direct beneficiary of the property, you in theory could sell that property a week after the parent's passing for $4 million minus closing costs, tax-free, up to $12.6 million or $25.2 million married filing joint. And people get confused because they're thinking, well, if I take that one benefit, then I don't get the other benefit, or how do I utilize both of these situations together? What's the best overall situation for me? That all comes down to proper tax planning, and that's what we do at Robert Hall and Associates.
Very cool.
Very cool.
It's complicated. It's very complicated because we're talking about property taxes. We're talking about there's estate taxes. There's income taxes. How many taxes are there?
It's a lot. I mean, and we're just talking about on the federal side. Then when you get to the state and local, and even the cities, all the way down to the city of Los Angeles has an AB 63 business license. They don't call it a tax; they call it a business license fee. But it isn't. It is a tax. By definition, it's not a tax, but it is at the end of the day a tax on small businesses. So, I mean, you're talking about. I think years ago, this was probably about a decade ago. Phil Mickelson, a very famous golfer, was being interviewed, and somebody asked him a question about the tax on his winnings. And he goes, "Oh, make no mistake, I will pay close to 50% of my income in tax." And he got a lot of heat for saying that because people are like, "No, that's not possible. That's not possible that you could pay 50+% tax on your income." Well, at certain income brackets, when you deal with the net investment tax, when you deal with the higher bracket income tax, which is 37% federal plus 3.8% net investment tax. And then you add on the states, which California can be up to 12.3%. Sure, when you add all of those taxes up, you're going to pay more than 50% of your income in tax. Wow. And so that's why Phil Mickelson probably has very good relations with his accountants. That's what keeps us gainfully employed.
So we're going to get now into the big, beautiful bill that Michael's going to ask you on. But one last point I'd like to make. Any particular property, there's many areas where a 3-bedroom, 2-bath home, okay, in La Cañada, in places like Palo Alto, they're worth beyond $2 million. So we're not talking about the filthy rich, folks. We're not talking about the super mega generating revenue people. We're talking about your average day American that their family bought a property, like you said, years ago. That property went up in value. Most properties in California, you can have a little shack, a 2-bedroom, 1-bath, and it's going for $1 million easy. So it's not just the super wealthy we're talking about. We're talking about the average American.
I would say in some parts, because like in Altadena, Pasadena, there was a lot of legacy homes and whatnot. But certain areas also, it's of a higher demographic that's moved in that wasn't there before.
Yeah,
sure. But so just to get into the big beautiful bill now, yes. And as business owners, you're a business owner. How long is this in place for? Can it be taken away?
This is one of the more strange questions that not strange questions. This is one of the strangest things about this bill.
Okay.
I have yet to see in my 20-year career, and Robert Hall & Associates has been around since 1971, and I've had conversations with our founder. I've had conversations with some accountants that have worked in the industry for a very long time, and we've all had kind of the same puzzling opinion about this bill. How can you add verbiage to a tax bill where you state that something is going to be changing permanently or indefinitely, right? Because every 4 years we have an election.
Right.
And we all know that when a new president comes in, depending on what side of the political fence they fall on, they tend to go back and change the prior president's tax bill changes, right? We just saw it with Donald Trump, with President Trump. He went back and basically changed the entire landscape of the tax bill, which was known as the Inflation Reduction Act under President Biden, and Trump's first term, the TCJA Act, Tax Cuts and Jobs Act. He took those TCJA parts of the tax bill and extended them, tweaked a couple things, but went back and took his first term's tax bill and extended it indefinitely. Now, his team also added the word permanent to a lot of things under this tax bill, which I don't know how possible that is. This is just a personal belief. I don't know how possible it is for a president to make tax code changes permanent. But the things that they are trying to or attempting to make permanent are very pro-business tax code changes. They are trying to make permanent the accelerated depreciation write-offs, which obviously for real estate investors, for small business owners, extending or making permanent the ability to fully dollar-for-dollar deduct equipment and furniture, as well as accelerated depreciation on real estate investments to help offset taxable profit and reduce liability. I don't see how that could ever be a bad thing. Once again, politics aside, I just don't understand how that could ever be a bad thing for business, right? I've mentioned this several times in my past webinars. since the big beautiful bill passed on July 4th, that this is by far the most pro-business tax bill I have seen in my 20-year career. It is meant to, instead of continuing to print cash, because we all know, including all of the listeners today, we all know that during the pandemic, more cash was printed during that time frame, I think, than I heard a statistic, than collectively over the last 20 or 30 years.
Over the last
something ridiculous.
30 years or something.
Yeah. And so instead of printing cash, this is what helps me sleep better at night, by the way, just the way that I'm thinking about this. Instead of printing more cash, why not soften the blow on the tax side for the American public, right? Why not create a tax code that allows people to make special elections on their returns with their businesses, with their real estate investments, to pay less overall income tax to the IRS in the state of California or whatever state they file in, which frees up cash in their own pocket versus printing cash and sending people refund checks. Well, we know that when we print more cash, it devalues the US dollar. That doesn't do anybody any good, right? So I always thought, well, why not loosen up the tax code side to allow money just to organically flow back to the US taxpayer? And that's exactly what this approach is. It is trying to free up cash by reducing liability, tax liability for the United States taxpayer. And that bonus depreciation change, which is set to be made permanent, that is a step in the right direction in accomplishing this goal.
So the bonus depreciation or accelerated depreciation, is there a difference between that?
There is. Good catch. So
because I'm thinking specifically a business owner who wants to buy a building to use for their business. Which one would they use?
So you just listed probably one of the most unique scenarios and probably one of the greatest tax sheltering benefits that a business owner could ever provide to themselves, which is owning and operating a business out of their own building. I've been working for Robert Hall & Associates for 20 years. I've known that Bob Hall and the Hall family have owned the building that we operate out of since I started there. I forget what year they purchased it in, but I learned very quickly that this part of the tax code has worked in a very positive way for a number of my clients. And whether it was the Inflation Reduction Act or Trump's TCJA Act or Obama's tax bill, the bonus depreciation side of the tax code has changed, but it's always been there. There are two categories. Well, there's a lot of different categories of how depreciation breaks out, but everybody tends to know about Section 179, which is the ability to go out and buy a microphone, to go out and buy a tablet, to buy a laptop, a piece of camera equipment, and dollar for dollar deduct it, all in 1 year. You have options, though. You can either dollar for dollar deduct it under Code Section 179, which is accelerating the depreciation on this asset, or I can spread it out over the lifespan of the asset. So let's say that I've already wiped out all of my profit and I'm paying nothing in tax. Why would I go out and buy a $1,000 microphone and take that as a dollar for dollar write-off when I didn't need it? I've already wiped out my profit, right? My cash flow. So I have the option of either taking it all in 1 year to offset liability or to reduce taxable income, or spread it out over 7 years, which is the lifespan of a piece of equipment. 5 years for furniture. Vehicles tend to be on a 5-year basis. But once again, through Section 179, we are able to take all of that write-off. Instead of writing it off over 5 to 7 years, we could take it all in 1 year if we have enough cash flow that needs more deductions in 1 year. With real estate, it's a little bit different. With real estate, it's not Section 179. It's actually a part of the code called, well, the election is called cost segregation. I know that we've talked about this in past, and you've heard me in other seminars talk about this. Cost segregation is a hybrid. I'm not saying it's part of Section 179, but it works very similar to Section 179, where a business owner goes out and buys. This is I'll use an example. This part of the tax bill is most commonly used for medical professionals, specifically dentist practices, where dentists tend to be that industry where they operate their business out of the building and they also want to own the building that they operate out of. Well, if they're operating a profitable business, a cash flowing business, and now they own the building that they operate out of, the IRS allows this business owner to set up a contractual agreement with themselves, with their business, to rent the building back to the business. Right? So if I own a profiting business, let's say my profit is $500,000. And obviously I don't want to pay tax on 500,000, so I have this contractual agreement with myself on the personal side, or maybe an LLC that owns this new building that I own, and I pay myself $100,000 in rent per year. Now all of a sudden the $100,000 is a write-off, office rents, through my dentistry practice. I am now including the $100,000 as rental income on a separate tax return that files this property investment, this building that I operate out of. And now this $100,000 in gross rents can be offset with the mortgage interest on the building, property taxes on the building, insurance on the building, CapEx improvements if I need to remodel or rehab the property in any way, shape, or form. And then I also get to take depreciation on the building. Now, commercial property, in theory, has to be depreciated over 39 years. That's commercial. Residential is 27 and a half years. We'll get to residential in a second. But in this example, that building would have to depreciate over 39 years. Just the building, not the land. Through cost segregation. So Section 179 is for equipment and furnishings and other things. Through cost segregation on the real estate side, I am able to tell the government, not only the federal government, but also the state of California in this case, that I do not want to wait 39 years to take this write-off. I can go with a third-party vendor. We use GTG Consulting out of Pasadena. There's a lot of cost seg specialists out there. But through a third-party vendor, they will go in and they will analyze the 39-year depreciation lifespan of the building, and they will break out any CapEx improvements on that building that are technically 20 years or shorter in lifespan CapEx improvement, the depreciable lifespan. Anything that is under 20 years can then be accelerated dollar for dollar as a write-off. So let's say you buy a building for $1 million, right? And let's say that it's a 60%, 40% split between building and land. So 600,000 is the building value, 400,000 is land. Can't do anything with the land. It is what it is. It just is land. The $600,000 building, if we didn't do cost seg, we'd have to write off $600,000 over 39 years. It takes a long time to get that write-off. Through a cost seg, we can take, let's say, $400,000 of the $600,000 building, and if it is all through this third-party analysis, if it is all considered to be 20-year or shorter improvement to the property, we're talking about the plumbing, the electrical, the faucet fixtures, the cabinets, the tiling, the windows. I mean, anything that is 20 years or shorter can be accelerated through cost segregation, dollar for dollar, all in 1 year. Well, let's rewind. If I have a $500,000 profiting business, right, and I'm trying to offset a majority of that, right, and let's say that I have $100,000 being paid as rent, I've wiped it out with all of the mortgage interest, property taxes, insurance, but then I have a $400,000 deduction that I get to take through cost segregation. Well, all of a sudden I have this huge loss over here through the real estate investment side. Well, if I am an active participant in this real estate investment, which I am, I own the building I operate my business out of, right? So as long as it is a non-passive activity, meaning I am actively participating in this investment, that loss, whatever that loss ends up being, will then pass through and offset profit on any other tax returns that I have on the that flow through to me personally. Well, I've seen this map out. I know this is a lot of information all at once, but from a macro view, what are we trying to accomplish? We are trying to take an asset, and instead of waiting for the write-off, we're trying to squeeze deductions out of it to offset liability on other profitable revenue streams.
So in very, very basic terms,
Sure.
for me, buying a building that I am going to use to for my business allows me to write off profits that I have from my business, and I can potentially if I have a year that I made a lot of profits, I can potentially do it all in 1 year, write them all off.
If the appropriate elections are made, the non-passive elections, remember that we're getting into the nitty-gritty details here, but there is a major difference between a passive investment, which you don't actively participate in, and the ability to deduct those losses. They're limited because I'm not an active participant in that business.
You have to occupy it.
You have to occupy it, and you have to actively participate in that business activity. That's called a non-passive investment. And yes, to answer your question, we are using losses to offset profit elsewhere. And remember that everything passes through businesses outside of C corporations, but an S corp, LLC, or even a sole proprietorship, it all passes through to me personally on the individual tax return. So the goal is to properly plan ahead before year end, see what my profit is, see what the tax liability is, and to figure out any way possible to use losses or other assets to offset and further reduce this taxable income. To overall, the goal is to pay less tax, to keep more money in my own pocket.
Right. And now
that's
you
the
own
goal.
your own building, and there's so many benefits. You can't get
course.
kicked out by a landlord or whatnot.
course.
I mean, how many businesses do we talk to that they say, my landlord decided to sell, I have to move, relocate, and
Many.
you have no say.
Happens a lot.
But cost segregation has been around prior to the Big Beautiful Bill. So how is it different now?
Great question as well. Under the Inflation Reduction Act, so in Trump's first term, he had brought 100% bonus depreciation to the table, both under the Section 179 part of the tax code and cost segregation. Well, when Trump's first administration was not reelected or not put back into the White House and President Biden won, President Biden went back to the TCJA Act and started altering a lot of Trump's tax code from his first 4 years of presidency. And under Biden, they were starting to phase out the bonus depreciation. I think 2022, it was at 100%. 2023, it dropped to 80%. 2024 dropped to 60%, and it was supposed to fully phase out, 20% decrease every year until 2027, to where depreciation was no longer, you didn't have the ability to accelerate it anymore. And so you just had to depreciate things over whatever the lifespan was, which was a big hit to the business owner.
Yeah.
Well, enter in Trump's second administration. He went back, wiped the Inflation Reduction Act off the table, reintroduced the 100% bonus depreciation, which once again is great for equipment, great for furniture, great for real estate, but it also applies to a lot of other things like company vehicles. I'm sure that most people have heard of this, but the bonus depreciation, I think, is the mecca of the tax world, is the real estate bonus depreciation, cost segregation. It is the holy grail of tax codes and tax shelters. However, right towards the end of the year, in the last 3-4 weeks of the year, I have a lot of clients coming to us with profitable numbers, thinking, well, I don't have enough time to buy real estate, but I want to figure out other creative ways to reduce liability. Well, we've already maxed out 401ks and IRAs and profit shares, DB plans. They've already prepaid for travel in the following year, in the calendar year, to help reduce. Well, then we also talk about bonus depreciation. Well, on December 31st, some of our clients have gone out. They've already been actively looking for a new vehicle in this case. I'm not the tax accountant that sends people out to buy cars just for the tax benefit, right? Yeah. But if you're already shopping for something that is a large ticket item like a vehicle, first off, there are ways that you have to title it, insure it, and pay for it, right? So if you're trying to take that
so call you first before you do it, before you buy.
Exactly. But on December 31st, we've had clients go out and buy Chevy Silverados and Chevy Tahoes and GMC Sierras, these heavyweight vehicles weighing over 6,000 pounds.
Right.
And as long as we title and insure and pay for it in very very specific ways, that car is now a dollar for dollar write-off once again for the business owner. $70,000 vehicle, dollar for dollar deduction. Now, unlike cost segregation, the vehicle is a great federal write-off. California did not conform to that part of the tax code. So we do have to we have to plan. That's the best way to wrap up, is I have to plan for the clients to make these kind of purchases and see how much it's going to save them in tax. Real estate cost segregation is a benefit for both federal and state purposes, so it's always going to be a larger tax shelter for them at the end of the day versus buying a vehicle.
So let's say that you actually bought a building, let's say 3 years ago, okay? And you were able to take losses during those 3 years on other things. Can you do the cost segregation on the fourth year for the year that's coming up, that let's say you're making a lot of money? You can choose the year?
You can, absolutely. So you wouldn't want to go back and retroactively do cost seg for 3 years ago.
No.
Because the tax bill was starting to phase out the bonus depreciation, right?
Correct.
But it works best, and I would have to ping my cost seg specialist on this, but I believe that it works best for newly acquired properties or properties that have only been in service for at least 2 or at most 2 years. I've seen properties do cost seg that have been owned for 3 years, but it works best with newly acquired properties because no prior depreciation has been taken, right? So it's, I don't want to get into the nitty-gritty details about this either, but when you first acquire a property, if you do cost seg in the first year of acquisition, you do not have to file a change of accounting method with the federal government, versus if I've owned this property for 2 or 3 years, when I do cost seg in the current year, I have to file this, I don't want to say a highly audited form, but it just brings a little bit of increased exposure to the individual's tax return. It's called a Form 3115, and it is an accounting method change, basically telling the government, hey, 2-3 years ago, I set up depreciation this way. Now, fast forward to 2026, I want to change it. And so you are filing not only the cost seg election to save all this money, but you're also making a very unique and very special accounting method change election with the IRS. So once again, it works best with newly acquired properties, but I have seen cost seg done on properties that have been owned for 2-3. I think the one that, or the longest owned property I've seen cost seg work on is 4 years. Anything that has been owned for more than that usually doesn't work. Now, I'll give you a very unique scenario. Let's say I've owned a property for
Did you say 4 years or 3?
Yeah, 4 years. I've seen one done on a 4-year-old property. But I do want to mention that let's say I've owned a property for 10 or 15 plus years, or let's say 20, 30 years. And all of a sudden it comes time for me to make some major renovations to the property. So I gut the entire property, break it down to the studs, and I put $1 million into that property and rebuild it back up. Well, I've added money to depreciable basis, right? That is a unique scenario. You can actually do cost segregation on any CapEx improvements that you've made to the property. So that is a different scenario. You still have to do the accounting method change, that 3115 form that I was mentioning. But now that you've put all of this CapEx money into the property, all of a sudden, I get to do cost seg on the improvement side.
Because your basis increased at that
Correct.
point. Got it.
Correct. And choose to accelerate that write-off, first depreciating to over 39 years for commercial, 27 and a half years for residential. So there are a couple different scenarios of how cost seg can apply.
Okay, excellent. So basically, it's when you say fairly new, you're talking about within a year.
Within a year.
Okay.
Now, let's say that a client purchased a property in 2025. We're sitting here, and it's first 2 weeks of January, right, 2026. If a client purchased a property in 2025, and now they're listening to this podcast and they're thinking, well, I should have done cost seg last year. Don't worry. Cost seg does not need to be done in the calendar year. You can actually do cost segregation on that 2025 acquisition in 2026 for the 2025 tax year. You actually can do the analysis right now for a property that you purchased last year because you haven't filed 2025's tax return yet. So the only kicker is that you have to do the cost seg election prior to filing the tax return.
Okay.
So it's not too late, is what I'm saying. People can still do the cost seg. I do want to mention that this all sounds great, right? It all sounds like it's going to.
It sounds too good to be true.
It sounds too good to be
Well,
true.
there's
exactly.
a cost to cost.
There is a cost. Well, there's a cost to do the analysis,
Yeah.
but then there is also a cost when you get ready to sell the property. And that's why usually in tandem in this conversation with cost seg, we talk about the 1031 tax deferred exchange.
Can we get into that, please?
Of course.
Because
So-
that's also part of the big beautiful bill, the
So
1031
there were no
exchange.
changes to Section 1031, thank
Right.
goodness.
Okay.
They were trying to cap the amount that you could exchange in a property in a 1031 exchange to $500,000 per single individual, $1 million for married filing joint couple. Listen, Section 1031 has been on the chopping block for a very long time. It's one of the oldest parts of the Internal Revenue Code dating back to 1921. And even though it's been on the chopping block under different administrations, at the 23rd hour they choose not to change it. Because once again, very much like cost segregation, it's one of the holy grails of the Internal Revenue Code.
Can you touch on it? Can you explain what it is
Sure.
for those who don't know?
Sure. So back in 1921, 1031 exchanges could be done with basically anything that was a capital asset. Our exchange professional, Phil Outwan, he always tells us a story. I don't know how true this is, but he says that the first 1031 exchange was done with a milk-producing cow back in 1921. I don't know if that's
I've
true.
heard him say that.
Yeah,
I don't know.
Okay. I don't know how
We like
true
Phil.
that is.
By the way, we had him here on
Yeah,
the podcast.
I love Phil.
He's-
Phil Outwan's one of the greatest human beings I've ever done business with. But then that story always rings a bell in my mind when I'm having this conversation because it's such an old part of the code, and it's been on the chopping block, and it has changed. That part of the code, Section 1031, has changed a lot, but it hasn't gone away. And when you have a president who is very pro business and pro real estate, like President Trump, I could have put money on the fact that they weren't going to change Section 1031. Well, For those of you who don't know what 1031 exchanges are, for those of you listening today, 1031 exchange is, once again, one of the holy grails of the tax code. It's the ability for me to take a property that I've owned for 20, 30, 40 plus years with a lot of capital appreciation. Bought it for $200,000, now it's worth $4 million. And if I sell it in my lifetime, if I just walk away from it and cash out, I'm going to pay tax on $3.8 million. Plus, if it's an investment property, I have to recapture all of the depreciation that I've taken over the past 30, 40 years, add it back onto the capital gain, and pay ordinary income tax on the depreciation. Well, when you sit down...
Can you repeat that real quick? Because you lost me. You said you bought it for 200, it's worth 400, so you're going to pay taxes on 3.8 plus recapturing the depreciation
on that $200,000 initial purchase, plus any improvements
see.
that I've made to the property over the years that I've depreciated as CapEx improvements. When I walk away from that property, I pay tax on the capital gain, and I have to pay all of the tax back on the depreciation write-off.
Right, because you took advantage of it.
So
Yeah.
what would they walk away with?
Not much.
Not much. And at that level of capital gain, you're looking at about 20% federal capital gain plus 3.8% net investment tax, which is you paying for free healthcare here in the U.S. So that's 23.8%. Plus in the state of California, an additional 9.3%. So you're looking at what, 33.1% in tax right out the gate. That's just on the $3.8 million capital gain. Now, we're being very general with the calculations. You can write off closing costs and on the sale, closing costs on the acquisition from 30, 40 years ago. There's some adjustments, but just for base calculations, 33.1% on $3.8 million. But then when I originally purchased the property and set it up as an investment property, I had depreciation, and it might have been small because it was only a $200,000 purchase.
Right.
But no matter what, that depreciation that I took on the initial setup of that investment property, I have to add all of that back as income on my return and not pay capital gain tax on it. I pay ordinary income tax on depreciation recapture. Well, over 30, 40 years, I'm sure that I've put more, or I'm sure that you've put, or whoever we're talking about,
A roof
has
on
put
it.
money into
Yeah,
the property.
whatever.
So all of a sudden, it's not only the depreciation on the 200 grand, but it's all of the other depreciable items that you've put on the tax return over 20, 30 plus years.
Wow.
So all of a sudden, you're paying a good chunk of that profit back in federal and state income tax. The only way to avoid that, not evade, right? Tax evasion is illegal, tax avoidance is not. So the only proper way to avoid that tax implication is to do a 1031 tax deferred exchange. That is taking this $4 million property and finding equal valued property. It could be 20 units, it could be one major commercial investment, as long as it is tangible, real property, right? I can trade that $4 million property and all of that equity and all of that capital appreciation for a like kind investment and defer the taxes. Once again, you're not evading the tax,
Right.
you're
You
just
defer.
deferring the liability, or kicking. I call it kicking the tax can down the road
Right.
until you kick the can. Because we had mentioned this briefly when we were talking about Prop 19, is that when you pass away, when I pass away with now let's say I've kicked this tax can down the road, now I own $15 million in real estate, right? Well, that might be too high because that's the estate exemption. Let's say it's $10 million in real estate. When I pass away, even though I've never paid the tax on all of this appreciation, I've just continued to 1031 exchange over my lifetime, the day that I pass away, depending on whatever the estate exemption is at that time, my either surviving spouse or my children inherit those capital assets with a full stepped up basis, tax-free. As long as I have not added them to title during my lifetime, as long as they've only just been beneficiaries to my estate or beneficiaries to my trust, as long as I've never added them to title, all of those assets are tax-free, and they get to reset depreciation up to the fair market value of the properties as of the date of my death. So once again, my original basis was $200,000 in this investment. Well, now it's worth $4 million, and I've done 1031 exchanges. Now I have $10 million of real estate, and I die, right? My kids aren't on title, but I leave $10 million of assets to them. My children could literally sell $10 million of assets the week after I pass away, tax-free. And so this kind of opens up a lot more conversation.
Is that because it was in a trust and it got a step up, or because...
It doesn't matter if it's in a trust. This is a question that we get a
Yeah.
lot as well. doesn't need to be set up in any specific
It
way.
would be better, probably.
Now, you want
right?
it in a trust to avoid probate in whatever
Right.
state you hold the assets in, but the stepped-up basis applies to any assets, any capital assets outside of tax-deferred retirement accounts, right? IRAs and 401ks that are deferring the taxes on revenue that you've made throughout your lifetime, those do not receive the stepped-up basis benefit. My stock that
What
I've
doesn't?
owned,
I'm sorry. What doesn't?
IRAs and 401ks.
Oh, okay.
Right, because
This
that's
is our
money,
pre-tax money.
That's money that I've never paid tax on. So
Right.
when I leave it for my children, they inherit the tax liability on my retirement income.
So $1 million 401k that you inherit, traditional 401k, the person that inherits it's going to pay taxes at their level.
Correct. And there are certain rules where you have to liquidate that 401k over a certain period of time
Yes.
once I've died. So
Can't just
once
sit
it
on
all
it.
comes back to proper tax planning.
Yeah.
Right? This is what we do at Robert Hall. We do all of this planning. For
It's
our clients.
complicated.
It's complicated. It's complicated. It's exciting though.
It is.
Yeah.
No, it is.
But the overall goal
It's better to
always
be informed.
is to pay as little tax as possible on all of this wealth that your parents have worked their entire lives to build, right? And you want to shelter their legacy, you want to protect their legacy. Well, there's a lot of planning that needs to be done in
Yeah.
order to accomplish that goal.
Or even if you're coming up, you're building a business, you're not necessarily inheriting anything
Sure.
yet or anything, but you can use tax planning, proper tax planning, to help, whether it's buy specific vehicles or assets or things like that. You know, the planning piece, I think, goes both sides. As you're building up, and as you're, like in my dad's position, he's thinking more what I'm gonna maybe leave, and
Sure.
thinking like, right, you're a little bit more in that stage, even though you're still building.
But it's cyclical. I don't know if that's the right term. It's cyclical because that's, your father's planning right now has changed because now he's got children and grandchildren. Well,
Right.
you have children, so your planning it will be very much the same as a parent's planning as the years progress, because
Sure.
then you're going to want to make sure that yes, you're establishing certain tax shelters to help you build wealth with the eventual goal to leave more for your children.
Right.
At least that's my goal.
Yeah.
Yes.
That's,
So 1031 is federal, right?
Correct.
So if somebody has a $4 million property in Idaho and they sell it, they could do a 1031 from Idaho and buy a property in California as long as they spend a little bit more, and
Correct.
vice versa.
Correct.
They could sell a property in California and buy it. Yes?
Now here, yes, correct. That does work, and the only thing that people want to realize, I to be real honest with you, I don't see too many people 1031 exchanging from another state back into California for a number of reasons. California is very unique. I'll use that word with a grain of salt.
Well, prices here are much higher, right?
Much higher, number one. Number two, California, once you have come back to California, you reset a clock on what's called the clawback clause in the state of California.
Let's talk about that,
Yeah.
Tommy.
So if I've owned a property in
So
Idaho,
that's coming back to California.
that's coming back to California or exiting California. So once again, let me give you one scenario. If I've lived in California my entire life and I've built wealth in real estate here, and let's say that I'm done with California legislation, I'm done with the California high tax rates, and I want out of California, and I take my $10 million in real estate and I exchange it for properties in 6 other states across the U.S. Well, sure, cost of living is a little bit less, but my California dollar goes a lot further elsewhere in the U.S., right? So now I'm sitting on $10 million, but 15 or 20 pieces of real estate versus my one property here in California. 10 years pass, and I decide that I'm done with real estate. I don't want to own real estate anymore. I just want to cash out. I want to be done with it. And I figure in the back of my mind, as just a U.S. taxpayer, that, well, it's no longer a California property, so I don't have to recapture depreciation in California. This is what gets people in trouble with the state. As soon as you left California, California started a timer on your properties, meaning that 10 years down the road, if you have not passed away and you are still very much alive and doing well, and you decide to sell all of your real estate now that it's in 6 other states, California says, okay, well, congratulations for exiting out of your real estate investments. But in the 20 or 25, 30 plus years that they were originally California real estate investments, we are going to recapture all of the depreciation and the capital gain tax while the properties were owned in California, even though you don't own California real estate anymore. So California says, great, have a wonderful life, but if you own those properties for 20, 30 plus years in the state of California, even though you're selling Nevada properties now and Texas properties and Florida properties, no state income tax, California claws back the 20 or 30 years of California ownership that you avoided paying tax on when you left the state of California.
And that's a current viable thing, because it sounds like it's not. That's legal.
Correct. So when
it's happening now.
When you sell real estate in the state of California and we put it on the tax return, we have to file an exchange calculation on the federal return, and we file an exchange form with the state of California. That exchange form goes into the digital archives with the state of California, and the federal government, whenever that property sells, the federal government notifies the state of California 10, 15, 20 years down the road and says, hey, this property was originally a California investment. Now you go fishing. The state of California, you go fishing.
Let's say you don't sell it, you die. At that point,
you reset the depreciable basis. There's
in
no
California,
capital gain
cannot
tax.
go after you.
California cannot go after you.
That's amazing.
But
Correct.
it was 10 years?
Well, if he owned it for 20, then
I
they're
was
going to
just-
go after the 20-year depreciation.
Correct. I was just using an example.
example.
Oh,
of the
so
time
it's
frame.
it's unlimited, that clawback.
No, it's not unlimited. It's how long the property was owned in California, and you took depreciation in California, whether it was 10 years, 15 years, or whatever. Then you should explain it, but I'm sorry.
No, you're right on. You're right on the nose.
So-
It's however long you own the property in California.
In California.
Correct.
And you took the depreciation in California,
Got
which
it.
was a benefit to you.
Mm-hmm.
Now you move to Nevada and you've been there 10 years and you sell it at the end of 10 years. If those
Got it.
properties were in California for 15, they're going to pull, it's called the clawback.
It
Clawback.
has nothing to do with how long you owned in another state.
Nope.
No, got it.
No. California wants their cut
Interesting.
because they figured that you saved California income tax in the years, and you took advantage of all of the California real estate appreciation benefit, right? California real estate is very unique. New York, very unique. Hawaii, very unique. So some of these states, there are about, don't quote me on this, I think there are 5 or 6, maybe 7 states that have the clawback clause. I believe New York is another one of them. Hawaii has a very unique real estate tax code as well. I'd have to look up the other
Yeah.
states. I forget. California is the main concern for a lot of our clients.
But
So-
the recapture to me is very interesting because it's not a capital gains, it's an income tax.
Ordinary income tax.
Ordinary income tax.
Correct.
So that's much higher than capital gains.
Well, because remember that when you are taking a
could be.
depreciation write-off on a rental property, is it saving you in each year that you take depreciation? Is it saving you capital gain tax? No, because there is no capital gain. It's ordinary income tax. So when you sell that property, all of that, let's say over 20 years, you've taken $300,000 of depreciation, saved tax, federal and state income tax on $300,000 of write-offs over 20, 30 years. When you sell that property and you walk away from it without doing a 1031 exchange, I pay the capital gain tax on whatever the appreciated value is, plus I have to take that $300,000 and add it back onto my return and pay ordinary. I basically have to pay all of the tax savings back,
State and federal?
state and federal.
State and federal.
Correct.
So let me shoot a quick question. So let's say that you have a living trust, and we've been talking about your primary residence, but let's say you own 3 or 4 other properties, whether commercial or residential. Okay? When you pass away, since it's in the trust, you're going to avoid the probate, but the properties are going to get reassessed.
Correct.
So your heirs, because of this amendment that was done to the California Constitution back in 2021, they're going to have to pay the new assessed property tax on all the other properties. Is there any way to avoid that kind of
So
stuff?
the only way to avoid it, from what I understand, like I said, this is not my specific lane of expertise,
No
but what I
problem.
understand is that in order to keep or inherit the basis, the property tax base, not the income tax basis, different world, but the property tax base on that property, on an inherited investment, you have to physically move into that property.
You can't, because let's say it's a commercial building.
Then
You're
it is
toast.
Toast.
Okay.
So the scenario is you own a commercial building, you pass away, your children inherit it. They can't move into that commercial building, so it's going to get reassessed for property taxes. You bought it 40 years ago. So your children are inheriting it, it's going to get reassessed at the much higher value that it is
Absolutely.
now, and they may not be able to pay that property tax.
So you have to sell it.
So they're forced
Well,
to sell.
so here is where people tend to look at one side of the fence and not both sides, because there are some decisions to be made here. they're thinking in the back of their mind, well, I can't afford all of this property tax payment. At this reassessed value, I just can't possibly afford that. But remember that this property that you might have purchased 30, 40 years ago for, I don't know, $200,000 that's now worth, let's just use $2 million as an example. All of that capital appreciation is built into equity in this property, right? Well, when the deceased is gone and you've inherited this property, the cash flow is probably there, right? I assume that over 20, 30 years, the rental income has increased with commercial, because it's not like it's a rent control, right? So the cash flow on the property is pretty high. So they're thinking, well, if I have to pay all this property tax, sure, it's a great write-off, but I still have to pay tax on all of this cash flow. That's not necessarily the case, though, because what also happens when a parent passes away and you inherit this property, you get to reset the depreciable basis on the property. So the depreciation write-off for a parent might have only been $1,700 a year, right? Because their basis was super low. They were paying tax on massive amounts of cash flow because their depreciation write-off was so small. Well, when a parent or a loved one passes away and now I've inherited this property at $2 million, I'm not taking $1,700 a month in depreciation anymore, $1,700 a year in depreciation. I'm taking depreciation on the $2 million value, not the $200,000 value. So all of a sudden, even though you're in the back of your mind, you're thinking, okay, higher property taxes, how am I going to afford that? Well, if all of the cash flow is now non-taxable because of the depreciation write-off, you have all of this tax-free cash flow from the investment, which should help with paying the higher assessed property tax bill. So
you can keep the property.
It doesn't work this way in all cases, trust me. Like, it doesn't always map out this way.
Yeah, because the revenue may not necessarily...
Exactly.
Yeah.
Exactly. So it's very property specific.
Okay.
Yeah.
Very property specific.
But it's a good point. You may not be forced to sell.
Just to give you a little background of where I come from, my family, I come from a lineage of, is that the right term? Lineage of real estate investors. My father and my mother were both real estate investors. My father owned commercial property in the high desert up near 29 Palms. Both were restaurants, and then they've also owned rental properties, residential rental properties. But the whole benefit of these, where was I going with this? I lost my train of thought.
We were talking about the fact that you might be able to keep the property.
The income might not offset the depreciation cost of it.
Correct. So even though I might not want to keep those properties, right? I can always take those investments and the cash flow. There was something specific I wanted to talk about, though.
Maybe you were going to say that you can offset it to any revenue that's being produced for any other business that you have?
Well, you can. It's just what I don't want to inherit the properties that my parents own, not because they're not good investments.
You might want to sell them. Is that what you mean?
Emotionally speaking, I don't know. Both of my parents are still alive. I don't know how I will feel owning properties that remind me of my deceased parents. It's just it's something that I lay awake at night thinking of.
Fair enough.
Just and so I see this with a lot of my clients. Some people are okay with it. They understand that this is a great cash flowing investment. But when a parent is gone, it's not like you have to keep those investments.
Yeah.
What you want to do is you want to talk to, obviously, a tax professional. You want to talk to real estate and investment professionals and see how to diversify that portfolio that your parents have left for you. It wasn't what I was going to talk about.
No, I know.
And
I tell you what,
really
life is this way. The minute we end the podcast, you're going to remember.
I'm going to remember, of course.
That's
of
fine.
course.
Well, you know what?
Course.
We'll bring you back.
Yes.
But
I'll get in my car and then I'll pull back in and we'll re-record.
But now, what was I going to say?
Now,
so it's extremely enticing to, because of the step up in basis, sell the property, get the cash. You're not going to pay any taxes on it,
Correct.
and then reinvest that.
Correct.
but who
Correct.
reinvests?
Yeah, well,
that's the tough part.
That's the biggest thing, is that if you're not looking to reinvest that money and you're just looking to liquidate, sure, the tax-free benefit is there.
Yeah.
But the whole point of having legacy assets is to give you a step up or a leg up on competition, right? And so what you do in that moment with inherited assets could forever change your future wealth building positions.
Yeah.
You don't have to stay with commercial. You can always keep the properties or sell them and take the tax-free benefit. You could always keep the properties and do that, make that calculation to make sure that it makes sense to keep the properties. A majority of my clients choose to sell not because they're not good investments, but because of the emotional factor.
Got it.
of keeping properties that remind them of their parents.
Are you,
know,
referring
that's
to
interesting because I've had the other side of the coin where they want to keep the properties that they grew up in,
Sure.
and they have all these memories like their primary home, which is a little bit different than the additional rental, let's say, or commercial property, right? Yeah, but you're right. Yeah.
But the majority you see sell.
The majority, even though I am advising them, even though it's not like my personal advice, because
Right.
my personal, I don't know how I will treat the investments that my parents will leave for my brother and myself. But my job as a tax professional is to show them the benefits of keeping the real estate, even with the higher property tax basis, even with the now active management of this real estate portfolio. It will be the most consistent dividend-paying asset you can park your money in.
Absolutely.
Because whether the economy is good or bad, people will always need a place to live.
Absolutely.
Commercial real estate we've started to see a little bit of a pickup again in commercial real estate post-pandemic. And so I've seen a lot of my clients do 1031 exchanges from restaurants into drop shipping centers, even exchanging their family real estate investments into syndicated investments in some cases. And once again, you don't have to lock yourself into those investments, but you want to know the financial side and how that's going to impact you. If you want to walk away and sit on the cash, that's fine. You can do that. But don't sit on it for too long. If just in a regular checking or savings account, you want to put that money to work for yourself. A majority of those California pieces of real estate, though, they tend to have incredible cash flow unless they are in rent control areas. But even then, because of that stepped up depreciation basis, their parents might have been paying tax on cash flow while they were alive, but because of this added depreciation write-off,
That's a good point.
past death,
That's
now they have all this cash flow that's tax-free.
Yeah,
yeah.
that's very
It's
interesting.
tax-free. So,
Which allows them to pay the current taxes at the newly assessed.
correct.
We can
Well-
start wrapping up. Anything else you wanted to throw in? We're gonna link up in the description for anyone interested in reaching out to Tony, where they can reach you. RobertHallTaxes.com. So you can set up a complimentary discovery call with his team, right?
Mm-hmm.
And they're excellent. I just wanted to touch on one other topic because politics and administration, it could be divisive, right? It could be you can get many different. And while I was doing research on this big beautiful bill, there were some negative views to it on certain cuts and whatnot. And then also for those who are not inheriting property or don't have a business, what do you say from your perspective as an enrolled agent tax advisor to those people?
Oh man.
Open a business. No.
Well, the funny thing is that you're almost spot on with that. It's the only way to exponentially grow wealth, whether it was under the Obama administration, the Bush administration, the Clinton administration, or now Trump, Biden, Trump, the only way to exponentially grow wealth is to be self-employed. I have very few clients, and I'm not saying that I don't have clients, but I have very few clients who have built exponential wealth as employees. It's just the way that the tax code is set up, that when you are self-employed, and let's say you're making, let's do a comparison. Let's say you have 100,000, we'll use smaller numbers.
Yeah.
Well, I'm not going to use $2 million, $3 million figures. Let's say we have a $100,000 self-employed business and a $100,000 W-2 employee. What is the tax difference between both, right? A $100,000 self-employed individual, we'll get to that in a second. I'm going to use that as the second example. $100,000 W-2 employee right out the gate loses about 8 to 9% to payroll taxes. Social Security, Medicare, state disability, unemployment insurance, and then the other half of their payroll taxes are paid by their employer. Now, in certain cases, employers will contribute to retirement plans. They'll pay for a portion of their medical costs, which is great. But at the end of the day, what Americans, specifically California residents, need right now is cash. They need cash. Cost of living is too high. Cost of raising children and having a family and putting away for deferred retirement, that cost to them is too high. They need the cash now to pay. I was talking to my wife about groceries. The amount of money that you spend on groceries per week. I'm looking at our credit card statements. I'm thinking, what are you buying? You buying golden eggs at the super? No. It's just the cost of living has gone up exponentially. Oh, yeah, she's all about organic, so that's probably where it goes. But the cost of living is so high for people that even 15, 20 years ago, $100,000 salary, it was decent. But $100,000 salary in Los Angeles County is no longer what it was 15, 20 years ago. And nobody can argue that it is, like, or it is or isn't. Like, it just isn't the same. So a $100,000 W-2, right out the gate, you lose 8 to 9% to payroll taxes. Then on top of that, if you were a single individual, no kids, on $100,000, you're at roughly the 17 to 18% federal income bracket, plus about 8% state, right? So you figure that 23, 24% in tax right off the top on 100 grand W-2.
24 plus 9.
24 plus 9,
Okay.
correct.
So
Right
we're
out
at
the
30
gate. So you're walking away
33.
with, yeah,
right?
you're walking away with what, $67,000
Yeah.
in net, even though you're making 100 grand. And we're not including any contribution to medical or profit share or retirement, for on the business side. We're just doing a very straightforward example. So 33 grand in tax on a $100,000 self-employed business. Depending on your overhead, rent back of in-home office, mileage, equipment, office furnishings, and reminding everybody that these expenses that I'm talking about, they are expenses that also the W-2 employee incurs, right? You buy a laptop, you buy a cell phone, you have mileage, you have groceries, you have meals, you have entertainment, but none of that is a write-off for the W-2 employee. Since 2018, you can't write off any of those expenses. So it's still 33 grand in tax right out the door for the W-2 employee. As a self-employed individual, most of your deductions, I'm not going to say all of your deductions, but most of your deductions are going to be dollar for dollar adjustments to taxable income on the 100 grand. There are very few times in Los Angeles County that I will see a $100,000 business gross income with very little overhead. It just doesn't happen in Los Angeles County. Mileage is high, insurance is high, rent is high. The cost of doing business in California is high. So on $100,000, if we are able to offset, let's just say 50% of that income with expenses, none of it is a write-off for the W-2 employee, but we get to write it off as a self-employed individual, dollar for dollar to offset. So that now we have $50,000 of net profit on the business side. Now you as a self-employed individual still have to contribute to Social Security and Medicare. It's known as self-employment tax, but you're only paying it on $50,000 now, not $100,000. So you're looking at about 15.3% because you're the employer and the employee, which is about 7 or 8 grand in self-employment tax. But you've now dropped your income bracket by 50%. Like literally you've dropped your taxable income by 50%. So the comparison, the reason why I'm comparing these two is that the tax liability as a W-2 wage earner is significantly greater always than the tax liability for the self-employed individual. In most cases, through proper year-end planning, we can get a self-employed individual's tax rate down close to zero. That means you made 100 grand in income in this calendar year and paid nothing in federal and state income tax through proper planning. The W-2 wage earner, it is what it is. So when you said this and you laughed about it, start a business, the W-2 wage earner, the only way to save themselves tax is to be the W-2 wage earner, but also start a business.
And that could mean what? Buy real estate, rental property, or open a business.
Correct. It could be all of the above. It could be buying real estate. It could be starting an e-commerce business. It could be doing, I have some W-2, perfect example, teachers, right? Teachers are all W-2s.
Yeah.
But if they start a tutoring business on the side, that is a Schedule C. And that Schedule C, if it shows a loss, because it's active participation in that business, that loss can dollar for dollar offset the taxable W-2 income that they receive as an employee.
You nailed it.
I'm telling you, starting a business. And so once again, the only way to exponentially build wealth as a United States taxpayer, I'm not talking about the executives at Netflix and at Google. Like they're the big W-2 heavy hitters, right? The only way to build wealth exponentially while saving or retaining wealth retention, right, through tax savings and tax planning is by being self-employed. I've seen it more times that way versus the W-2. Now, the married filing joint couples where one person is a W-2 and the other is a self-employed individual, that is the golden scenario. Because now we can have a heavy hitter W-2 on the tax return and use the spouse's business to help offset the tax liability on the W-2 income. So once again, every scenario is unique and different.
I really liked your answer that it's in all administrations. This is opening a business, being able to write things off. It's not just the current administration.
Correct.
So thanks for sharing
each administrative change, they tweak changes to the code. They tweak little things about the code, but the Internal Revenue Code, at least since probably the early 80s, the web of the Internal Revenue Code since the early 80s has been spun to benefit the business owner and the real estate investor. And until the IRS until a new administration changes the self-employed individual's ability to dollar for dollar deduct expenses, that's when the advice might change, and that's what might change the path that we're all kind of on as United States taxpayers. But the reason why I say the early 80s is that's when alternative minimum tax started to change for business individuals. So that was a major shift in tax code and bottom line liabilities overall. But like I said, this new tax bill is incredibly pro-business. There has never been a better time for the United States taxpayer to seriously consider starting a business or even pivoting to become a self-employed individual. I mean, here in Los Angeles, we see it all the time, especially since the strikes in the entertainment industry. A lot of people who had been working in the entertainment field for 20, 30 plus years, they're at a standstill.
Yeah.
They're not making any money. So they've had to pivot into real estate. They've had to move out of California into a lower cost of living state. And now they're planning their roots and starting businesses, and now they're starting to see light at the end of the tunnel. But there are always economic shifts and always economic changes.
Yep.
The tax code, life, death, and taxes, right?
Yeah.
The tax code plays into all of these life changes and these scenarios. And that's what Robert Hall and Associates is here to help with.
And do you guys take only high income earners? Do you take? I mean, what's your ideal client?
Yeah, we're very transparent about who will benefit from using our services the most. It does not tend to be the baristas at Starbucks, or even the single individuals who are teachers just getting started in their career. Now, a married filing joint couple where one spouse is a teacher and the other is a self-employed individual, sure, that fits the mold there.
Okay.
We are very transparent with who we can help.
Great.
But what I always suggest to people right out the gate for our free consultation is to send us a copy of the most recently filed return. Let us review that return, see if we can make any changes for you moving forward, see how much we can save you. And if we're not in the business of over-promising and under-delivering. We want to under-promise and over-deliver in 99% of the scenarios, right? 100% of the scenarios. Yeah. Without seeing what has been filed in past years, we won't know how to advise moving forward. And if we can't help somebody, we'll straight up tell them, maybe right now is not the right time to onboard with us, but as soon as you buy your first rental property, as soon as you start your first business, give us a call, and we can map out those planning scenarios for you.
Thank you, Tony.
Of course.
Thank you.
Anything else
Tony.
you want to add in?
No, that's it.
Anything else you wanted to add, Tony?
Just make sure that I was told, I think it was like the third or fourth day that I worked for Bob Hall. As a very green individual, 20 years old, 3 days into working for him, I didn't know if I had made the right choice 3 days into that first tax season. But he looked at me and I said, listen, Bob, I'm trying to map all of this out. I'm trying to connect all the dots. Like, what's the overall goal here? And he goes, Tony, throughout your career in the tax world, you always have to remember a lot of things, but you have to remember one thing specifically. It's not about how much somebody makes. It's not about how much somebody spends. It's about how much they get to keep in our industry. That's always what it is. And through proper planning, the goal is always to pay your obligation in tax and not a penny more than that obligated amount. So just always remember that. It all comes down to proper planning, and that's what Robert Hall and Associates is here for.
Okay.
Thank you very much.
Thank you very
Reach out
much,
to
Tony.
Tony. We'll put in the description all his information, and thank you for your time.
Thank you for having me.
Thank you.
Take care.